Till now, India's retirement system worked in a fairly simple way. If you had a formal job, your employer contributed to your provident fund. You built a retirement corpus over the years, and when you retired, you could withdraw the money or receive a pension under existing schemes. But what if you are a Swiggy delivery partner, or an Uber driver, a freelancer, or a construction worker, or simply someone who has never had formal employer? Hi, I'm Nupur and you are watching Control Z, your cheat code to navigating adulthood. So, for millions of Indians, retirement planning simply doesn't exist. That may be about to change. According to a report on Indian Express, the Employees Provident Fund Organisation or EPFO is working on what could become the biggest expansion of India's social security system. One that aims to bring pension coverage to workers who have never been a part of it before. Over the past year, EPFO focused on making the existing system easier to use. It launched a revamped portal, merged 123 regional databases into a centralized system, and simplified claim settlements under what officially came to be known as EPFO 2.0. Now comes the bigger challenge: building a system that doesn't just serve salaried employees but potentially India's entire workforce. That means extending social security to more than 60 crore workers, most of whom are in the unorganized sector. Today, most gig workers and informal workers don't have any structured retirement savings. EPFO wants to change that. The proposal is to create a universal pension framework where anyone from a salaried employee to a delivery partner or self-employed worker can build a retirement corpus over time. The contributions won't necessarily come from just one source. They could come from the worker, the employer, the government, digital platforms like food delivery companies, or even CSR and third-party contributions for lower income workers. That's a major shift from today's EPFO model. Imagine opening a retirement account. Every contribution made in your name gets added to one common pool linked to your universal account number or UAN. That money is then invested in government-backed securities and earns interest, much like today's provident fund. Over time, your retirement savings continue to grow. When you retire, you won't have just one option. Instead, you'll get to choose how you want to receive your money. Now there are two ways to take your retirement money. The first option is familiar. You can convert your savings into an annuity that pays you a fixed monthly pension. The second option is more flexible. It's called a systematic withdrawal plan or SWP. Instead of locking your money into a fixed pension, you decide how much to withdraw every month while the remaining corpus continues to earn returns. If you need more money in the early years of your retirement, you can increase your monthly withdrawal. But if you want your savings to last longer, withdraw less and let the balance continue growing. It's similar to the way many mutual fund investors withdraw money after retirement. Now, another new feature being considered is a personalized retirement target. EPFO calls it the Target Retirement Sum or TRS. Instead of simply tracking your PF balance, the system would estimate how much money you need by retirement. It would then show whether you're on track or not. If you are falling short, the platform could suggest how much more money should you contribute and how often. Users would also be able to see inflation-adjusted projections and compare different retirement scenarios before making any decision. But what about gig workers? Well, this could be one of the biggest changes for them. Today, many gig workers work for multiple platforms at the same time. Someone might deliver food in the afternoon, drive a cab in the evening, and take freelance assignments over the weekend. The proposed system would allow one universal account number linked to multiple employers or aggregators, so every contribution from every platform gets reflected in a single retirement account. That means your retirement savings move with you, even if your jobs don't. Now, one proposal is particularly interesting in this whole scheme of things. When you place an order on a food delivery app, you're often asked whether you'd like to add a tip or make a donation. EPFO is exploring whether similar payment systems could eventually allow a small portion of a transaction, if permitted under the final framework, to be diverted towards the worker's social security account. Officials say the platform is being designed to support such flexible contribution models in the future. Whether and how such features are implemented will depend on the final policy. To manage millions of additional workers and transactions, EPFO also plans to adopt a core banking solution or CBS. This is the same technology that banks use to process deposits, withdrawals and payments in real time. Officials believe adopting a banking-grade platform will make EPFO capable of handling social security for a workforce of more than 60 crore people. But is this proposal final? Well, not yet. These are proposals currently being developed as part of EPFO's next phase of reforms. Many details, including contribution rates, implementation timelines, and the final design of the universal pension scheme, are still being worked out. But if these proposals become a reality, EPFO would no longer be just a provident fund organization for salaried employees. It could become the backbone of India's social security system. And for millions of people who have never had formal retirement benefits, that could fundamentally change what retirement in India looks like.